Most people think they understand how credit cards work. You swipe, you get the bill, you pay it. Simple. But there's a version of that story that credit card companies spend billions of dollars making sure you never think too hard about. And by the end of this video, you're going to see exactly what it is. Right now, your credit card company is either making money off of you or you're making money off of them. There is no neutral. There is no break even. Every single month, one side of that relationship wins and one side loses. And the uncomfortable truth is that the vast majority of people using credit cards have no idea which side they're on. Today, I'm going to show you exactly how to figure that out in about 30 seconds. And if you're on the wrong side of that trade right now, I'm going to give you a concrete path to flip it. But first, if you carried a credit card balance from last month and you've used your card today, even for coffee or gas, I need you to stay with me because what I'm about to explain changes the math on every purchase you're making. Let's start with something most people have never even thought about. Credit card companies have 3 completely different revenue streams, and they make money from very different customers with each one. Stream 1, interchange fees. Every time you swipe a card, the merchant, or in other words, the restaurant, the gas station, or the grocery store, pays a fee to the card network, usually between 1.5 and 3.5% of the transaction. You never see this. The merchant absorbs it. This happens on every single transaction, whether you pay your bill in full or not. Stream 2, annual fees. Straightforward. You pay the card company to use their card. Premium travel cards can run $500, $600, or even $700 a year. The card company earns this whether you're responsible or not. There are some cards that do not have an annual fee, but many do. Stream 3, and this is the big one, interest charges. This is where credit card companies generate the majority of their profit. The average credit card interest rate right now is sitting around 24%. To put that in perspective, the stock market has historically returned about 10% a year. Credit card companies are charging you more than double that on money you've already spent. Some cards go as high as 29% or 30%. This revenue only comes from one type of customer, the person who carries a credit card balance. Here's the thing about those 3 streams. The first 2 are just the cost of operating a payment network. Fine. Merchants decided a long time ago that accepting cards is worth the fee. Annual fees are optional because you can get a no-fee card. But that third stream, that's not a cost of doing business. That's a trap, and it's specifically designed to be one. There are only 2 types of people using credit cards, and I want you to figure out which one you are. Type 1 is the harvester. This person pays their balance in full every single month without exception. They never pay a dollar of interest. When they use their credit card, they collect rewards like cashback, points, and miles. They get purchase protection, fraud liability coverage, sometimes even travel insurance. They are, in effect, getting paid to use someone else's money for 30 days. They are extracting value from a system that was designed to extract value from them. It's a real-life Uno reverse card. Type 2 is the harvested. This person carries a balance, maybe a small one, maybe a large one. Maybe it started small and crept up. They pay 24% annual interest on money they already spent. And here's the part that's genuinely brutal. They're paying 24% interest on things that they may have already consumed, used up, thrown away, or forgotten about. That dinner in February, that car repair in November, those purchases are gone. The interest bill is still here. Which type are you? The test is simple. Do you pay your statement balance in full every month? Not the minimum payment, not most of it, all of it. If yes, you're a harvester. If no, you're being harvested. Here's a rule that sounds obvious once you hear it, but that almost nobody actually follows. Never use a credit card that is carrying a balance. Here's what most people don't realize. The grace period, that 25 to 30 day window where you're not being charged interest, only exists when your previous balance is 0. The moment you carry a balance into the next month, the grace period is gone. New purchases start accruing interest immediately. So that $50 grocery run you made today, if there's a balance on that card, interest started accumulating on it tonight. So, what you're actually doing when you swipe a balance carrying credit card is choosing to buy that item on a 24% APR loan. And you're choosing that consciously or unconsciously every single time. Think about it this way. If a friend came to you and said, "Hey, I found this great deal. I can borrow $60 to buy groceries, and I only have to pay 24% annual interest on it." You'd tell them that's a terrible idea, but that's exactly what happens every time someone uses a card they haven't paid off. So the rule is, if you're carrying a balance on a card, put the card in a drawer. You don't need to cancel the card because that doesn't change the fact that you have to pay the balance, and that card could be helping your credit score. Just stop using it. Use a debit card for day-to-day spending until the balance is cleared. Now let's talk about something almost nobody in the personal finance space talks about when they talk about how to pay off credit card debt. Most people in credit card debt do one of two things. They make minimum payments and watch the balance barely move, or they throw whatever extra cash they can at it month to month. Neither approach solves the underlying interest problem. Here's a better option: a debt consolidation loan. Right now, a debt consolidation loan can run between 10% and 20%, depending on your credit score. Compare that to a 24% on a credit card. That could save you thousands of dollars on interest alone, but the interest rate is only part of the story. The structure matters just as much. A personal loan has a fixed term, say 24 or 36 months. You'll know exactly when you have it paid off. You know exactly what your payment is. And there's a cap to the amount of interest you'll pay. And there is a finish line. Credit card debt has no finish line. Minimum payments are calculated to keep you in debt as long as possible. That's not an accident. It's designed that way. So if you're carrying significant credit card debt right now, here's a concrete action. Find out if you can qualify for a debt consolidation loan or a more narrow credit card consolidation loan. If you can get a loan with an APR that is lower than your current interest rate, take it. Check several different lenders. Find the offer with the lowest APR. We've got a tool at the Yukon project specifically designed to solve the comparison problem. It lets you see what lenders would offer you specifically. If you visit our lending marketplace page at the Yukon project, you can check your rate with up to 40 lenders with a single application. Just select debt consolidation or credit card consolidation for the purpose of your loan, the amount you need, and your rough credit score. When you apply to any one of the featured lenders, we will automatically check your rate with up to 40 other lenders. Our partners use a soft credit check, so applying won't hurt your credit score. We will show you all of your approved offers so you can be confident you're getting the lowest rate you can qualify for. By consolidating, you will pay less in total interest. You will have a clear end date, and you will close the open loop of revolving debt. This is powerful, but you have to avoid the double debt trap. Don't immediately run the credit card balances back up. If you take out a personal loan to pay off a credit card and then build up a new balance on your credit card, you've doubled your problem. The loan is a tool for you to get out of debt. Your behavior is what keeps you out. You may have heard about 0% balance transfer offers. This is where you transfer your credit card balances to a card with an introductory 0% interest rate. Those can work too, but they come with transfer fees, a limited window, and if you don't pay it off on time, the deferred interest may hit you all at once. If used correctly, it can save you a lot of money on interest, but this approach will demand more of your attention to be successful. A debt consolidation loan is simpler and more predictable. Let me make the benefits of a debt consolidation loan concrete with real numbers, because I think abstract percentages let people off the hook mentally. Let's say you have $5,000 in credit card debt at 24% APR. The minimum due payment is designed to barely cover your interest charges, meaning your principal balance hardly moves. It might only pay down the principal by 1 or 2%. On $5,000 of purchases, you will end up paying nearly $9,000 in interest by the time you've made your last payment. You're paying for those purchases 2.5 times, and it's taking you 20 years. That's a winding, expensive path for credit card debt payoff. This is what's sometimes called the minimum payment trap, and it's one of the most expensive financial mistakes a person can make without even realizing it. Now let's say you have a personal loan with that same $5,000 at 15% APR on a 36-month term. Total interest paid roughly $1,200. You're out of debt in 3 years, and you saved over $7,500. It's like getting a $200 a month raise just by switching to a debt consolidation loan. The general rule of thumb is this: if you can get a debt consolidation loan that is at least 2 or 3 percentage points lower than the interest rate on your current debt, you should take it. But obviously, the lower the better. Remember, that savings is not a small difference. It's a vacation. That's a used car. That's several months of rent. Now, I want to be completely fair, because if you use credit cards correctly, they can be a great financial tool, and it's a way for you to extract value instead of being the value extracted. Let's consider that same $5,000, this time charged to a 2% cashback card and paid in full the following month. The cardholder earned $100 in cash back. They paid $0 in interest. The merchant paid the interchange fee. That person came out $100 richer than they were before. As a harvester, credit card rewards might be the most lucrative benefits you get, but they aren't the only ones. Using a card this way can help your credit score. Paying off the card means that you will have a lower credit utilization ratio and a consistent history of on-time payments, both of which put upward pressure on your credit score. Using a credit card can give you fraud protection. One of the benefits of credit card usage is that you have stronger fraud liability protection than you get from debit cards. Federal law limits your liability to $50, and most credit card companies offer zero liability protection. You can also get purchase protection. Many credit cards automatically extend manufacturer warranties and provide coverage for damaged or stolen purchases. Some cards offer travel protections. Many premium travel cards offer trip cancellation insurance, lost luggage reimbursement, and rental car insurance. None of these benefits cost you a thing if you pay in full. They are entirely free to you. The credit card company funds them from interchange fees, annual fees, and the interest payments on people who do carry balances. You can benefit from the system without being exploited by it, but only if you never carry a balance. Now let's bring this back to the original idea. Credit card companies are either taking advantage of you or you're taking advantage of them. Which side you're on comes down to one behavior. Do you pay the full balance every month? If you do, keep using your card, collect your rewards, enjoy your protections, watch your credit score go up, and let the credit card company fund your lifestyle with merchant fees. If you don't, stop using the credit card immediately. Look into a debt consolidation loan with a lower rate with a fixed end date, and commit to never carrying a balance again once it's paid off. The credit card industry built a $200 billion business on one assumption: that most people won't do the math. We just did the math, so use it. If you found this information helpful, please like this video and subscribe to our channel. Your support helps us out, and we appreciate it. Thanks for watching.